Hello everyone, today is Tuesday, November 18th, 2025. Hope everyone is doing well in health and strength, mentally and physically. Welcome to Tax and Accounting Ride Along, brought to you by Sands Virtual Enterprise, LLC. Your go-to dose of straight-talking tax and accounting insights for small businesses and the everyday taxpayer in the general public. Today we are going to be taking a deeper look into one of the most misunderstood IRS tax relief programs. The IRS Fresh Start program, in particular, the IRS Offer in Compromise. So without much further ado, let's crank it up and get straight to it.
Okay, let's dive deep today. We're unpacking something pretty significant. The IRS Offer in Compromise. You might hear it called the Fresh Start program sometimes.
That's right. It's really aimed at taxpayers, individuals, and businesses who are facing tax debts they genuinely just can't manage to pay off.
So our mission here is to really pull out the essential info. Who qualifies, how does it actually work, and importantly, some critical warnings people need to hear.
Absolutely, because navigating this can be, well, tricky.
Okay, let's start with the basics. Offer in Compromise. Sounds like a negotiation. Is it like haggling with the IRS, or is it more structured?
It's definitely more structured. Think of it less like haggling and more like applying for a specific kind of relief. The IRS agrees to accept less than the full amount owed, but only based on very specific criteria related to your ability to pay.
Ability to pay.
Okay.
So what qualifies? How do you prove that?
Well, there are three main grounds. First, doubt as to liability. Basically, you doubt you even owe the tax. That's less common for OICs.
Right.
Second, doubt as to collectability. This is the big one. You agree you owe it, but you simply don't have the income or assets to pay the full amount now or, in the foreseeable future.
Okay, that makes sense.
And the third, effective tax administration. This is where paying the full amount wouldn't just be difficult, it would cause an unfair economic hardship. Or there are other compelling public policy or equity reasons, but doubt as to collectability is really the most frequent path.
Got it. So let's talk numbers. If someone owes, say, $50,000. How does the IRS figure out what lower amount they might accept? This feels crucial.
It absolutely is. They calculate what's called your reasonable collection potential, or RCP. This isn't just a vague guess.
LCP.
Right. They look at your income, subtract necessary living expenses, and their standards for necessary are pretty defined to find your monthly disposable income. Then they typically multiply that monthly amount by, usually 48 months if you're offering a lump sum payment pretty quickly, or maybe 60 months if it's over a short-term payment plan.
Okay, 4 or 5 years of future disposable income.
Exactly. Plus, they add in the equity you have in your assets, like your house, car, savings accounts, minus certain allowances and exemptions. That total, your net asset equity plus that projected income, that becomes the minimum offer amount the IRS will generally consider.
Wow. So it's not just saying I can't pay. It's a hard calculation based on everything you own and earn, projected out for years.
Precisely. Which leads us to the application itself. It starts with some very detailed financial disclosures. Form 433A for individuals.
And 433B for businesses.
Correct. And the 433A particularly is intense. You're essentially opening up your entire financial life, income sources, bank accounts, expenses, assets, everything.
That's evasive.
It has to be, from their perspective, to verify that RCP calculation. Then you submit Form 656, which is the actual offer document, along with all that backup.
Now, I heard the IRS has a new online tool. Does that simplify things much?
It helps. It's a pre-qualifier tool. It gives you a potential eligibility check based on some initial figures you plug in. It can sort of screen people out early if they clearly won't qualify.
Okay, so it might save some wasted effort.
It might. But look, it doesn't replace the need for the full 433 financial statement or guarantee acceptance. The core complexity, gathering all that proof, calculating the RCP accurately, presenting it right, that's all still there.
And that complexity.
Yeah.
That leads to the big warning sign we need to talk about. These offer in compromise scam mills.
Yes. This is really important. We've seen reporting, Bloomberg mentioned this too, about companies making really aggressive, often misleading promises.
Like what kind of promises?
Things like settling your debt for pennies on the dollar guaranteed, really fast. They charge hefty upfront fees, often thousands of dollars.
And the reality?
The reality is often grim. Many of these outfits submit sloppy or incomplete applications, maybe based on false information, which the IRS quickly rejects, or they just take the fee and do nothing. The taxpayer is out the fee, still owes the IRS, and might even face penalties.
So they prey on the desperation and the complexity of the system. Why can't the IRS just filter these bad actors out more easily, especially with that new tool?
Well, the tool helps a bit up front, maybe, but the process has to be rigorous to prevent fraud against the government, you know? If it were too easy, everyone would try it. That high bar, combined with how overwhelming this is for someone already stressed about debt, it just creates an opening for these scammers.
Which really underlines the value of getting legitimate help, like from a qualified CPA or an enrolled agent or a tax attorney.
Absolutely essential, I'd say. Someone experienced knows exactly what the IRS is looking for on that Form 433, how to calculate the RCP correctly, how to frame the argument based on those grounds, collectability or hardship. They can make sure your offer is realistic and properly documented.
It drastically increases your chances of actually getting the offer accepted. They know the rules, the real rules.
Exactly. They focus on meeting the technical requirements, not just making an emotional plea.
Okay, so wrapping this up. The OIC program, the Fresh Start Initiative, it can be a lifeline for people truly drowning in tax debt. But it's a demanding technical process.
Very demanding. Success hinges on that detailed financial proof and meeting the RCP threshold.
Which brings us to a final thought. If the IRS creates a program specifically for financial hardship, but the process itself is so complex, it basically invites these predatory scam operations. What does that tell us? It kind of raises a question, doesn't it, about how you balance the need for strict rules to protect taxpayer money with making relief genuinely accessible to the vulnerable people it's intended for.
That's a really important tension to think about. How do you make help reachable without making it easy to abuse?
Something for you to mull over as you look into potential solutions for tax issues.
Well, folks, that's a wrap. Thanks for joining us for another episode of Tax and Accounting Ride-Along, courtesy of Sands Virtual Enterprise, LLC. Got feedback or curious questions? Or maybe a topic that needs some airtime? We'd love to hear from you. Connect with us at admin@sve-accountingandtaxes.com or text us at 4045-858513. Also, follow us on Facebook, Instagram, TikTok, YouTube, and LinkedIn for more insights. Catch you next time for more business talks and good times.